In today's video we are going to discuss pure price action. So we're trading using nothing but price action and order flow. So we've got zero indicators apart from the VWAP, the session VWAP, just so we can tell where we are in relation to that session. But before we get started with some real chart examples, let's go on to a sketch pad and discuss exactly what I'm looking for. So it's very important trading, if you don't know, that you define an asset, a time frame and a session. All successful traders trade the one model on the one time frame, on the one asset and in the one session. Now my session here for this example, I actually do trade London and New York. I don't recommend it when you're just starting out, and I also trade this on NQ and gold. Again, I wouldn't recommend both starting out. It's very important to stick with one asset, one time frame, one session, so that you can really become a master of it before introducing anything else. So here in this example, my session that I define a session is unique. It's 90 minutes before New York Open, so 9:30 Eastern Standard Time. I'm trading about an hour to 90 minutes before that, and about an hour to 90 minutes after that. So I've wrote here 8:30 to 10:30 Eastern Standard Time, or it could be 8 AM to 11 AM Eastern Standard Time. The only caveat here is I do not trade the open, the initial open. So for that 15 minutes when the market opens, I tend not to trade then. Okay, next thing, M15 in the bottom left hand corner. This is the time frame. I do not trade any other time frame apart from M15. When you look at the charts so much in a certain specific defined session on the same time frame, on the same asset, you actually get a feel for the flow of it. It's hard to articulate into words, but you get a real flow for it. You end up entering something people refer to, you've probably heard the phrase flow state. And you can get into a flow state only once you've put in hundreds of hours on a particular asset, on a particular time frame, in a particular session. So what we're looking at here, the main thing here is we are just looking for the breakout of this level. We can see this level has been created here. It's been respected. Yeah, it's creating this, let's call it resistance. But more importantly, the reason why I would take this is because we have a clean range to the left hand side. What do I define as a clean range? Multiple bearish candles. Okay, you can see here we've got three big bearish candles and you've got very little consolidation or anything in this area. So if you do break this level, chances are you're not going to run into any consolidation or any points where it's going to bounce. Now, the most important thing with my model is 15-minute candle opens. Okay, it opens here. Now, if this surges right through, okay, if it starts to surge right through and there is no wick at the bottom, I'm absolutely not going to take my full position. So let's just pull a figure out there of $100. So if you're risking $100 in a trade, if this breaks through here without a bottom wick, I'd potentially only risk $50. Okay, I would risk $50 because 95% of candles have wicks. So when this is going up and it's going through, I'm automatically thinking this is the wick of what is going to be a bearish candle getting formed. Okay, but let's say it ends up a bullish candle and you went in with half your position. You've got another opportunity to get in with your full position, because again every candle creates a wick. So if this comes back down here and it could wick you in, okay, maybe it doesn't come back down there then if it doesn't come back down there, what you could do is you could enter your next size when we break this wick or when we break this body, because when we break this body, this candle, this bearish candle, is essentially going to be flipping from bearish to bullish. So that's where you could enter your other 50%. Okay, so let's say, as an example, the perfect setup for me, right? The perfect setup. Candle opens, we create a wick, and time is everything. I have defined that I do not want to enter a trade in the first 3 minutes of a 15-minute candle, and I want to be out of the trade before the 15 minutes because it creates a wick at the top as well. So this up here could have been minute 12, and then it retraces down, and this is minute 15. And it happens every time. Look at a chart and look at all the candles. 95% of them have got wicks at the top and wicks at the bottom. So this is a game of probabilities. So why would you be staying in a trade on a 15-minute candle that is, you know, more than likely going to retrace back down? So perfect setup is candle opens, we come down here, candle comes back up, and we break through here in after minute 3. And again, certainly before maybe minute 7, minute 8, because you want to give your trade 5-6 minutes to play out. Okay, so we'll look at some real life examples just in a second, but I wanted to illustrate here just on a graph what we're looking at with the 15-minute candle. So I'll wait 3 minutes when the candle opens. Again, if it looks good, right, if this looks good and this wicks in, yeah, I would still maybe enter in 2 minutes. Again, it just depends. If this wick's already in, then we're moving up and it's, you know, 2 minutes 30 seconds, I'm not going to not take the trade because the wick's in and it's came up. I'm just saying, on average, this setup takes about 3 minutes to happen. So let's go and look at some real life examples on a chart. So we're on NQ. You can see here. I'll go over to the first one here, the first example. So we're in NQ. You can see here where we're forming this resistance area. Okay, a big strong candle comes up and we break through this level, but there's no wick on the bottom of the candle. So this is the exact scenario that I was talking about in my sketch. I would potentially take this trade entering only half of my position, and then look what happens, it comes back down and retests. So again, I could enter my other half a position here, and then away it goes. Again, stop loss here isn't really defined, probably underneath VWAP because this candle is too big. But this is a perfect setup where you would only enter half because you've got no wick, half your position, and then when it comes back down and retests, you can enter the other half. So that's just one example there. Let's move on to the next. Next example, perfect setup. You can see here we're struggling to get through this area. What is to the left? Clean range, very important. This clean range, like big bearish candles. We don't want to be trading into any consolidation or levels. We're just trading into this big clean range here. When we break through it, the wick's already in. You see this? The wick is already in. So we enter our trade here full position and we target here. So this trade would look like this. Stop loss would just be below the wick, and you'd be targeting that area up there. There's a good 3-to-1 trade. I would even consider tucking the stop loss up underneath the body, because again, if it flips from a bullish to bearish candle at that point, when it comes back down, and you know, if it would flip at this stage. So your stop loss can either be here or it can be up here at the body. So you change a 3-to-1 into a 6-to-1. You're targeting up here, but you're also trading back into VWAP. So next here. So we do have a clean range on this trade, and it's over here. You see all these bullish candles, this bullish move up. If I just move over here, you can see this was a little consolidation bit here and a big trade up. So that's what we're trading into over here. I lost my position. Here. So again, we are forming support here. You can see that we're really struggling to break through this area. It's been wicked, and then we come into the session and then we break through. What do you notice? The wick is already there. Yeah, so the wick is already on the candle, and then we break through. And again, you've probably broke through here around about minute 3. And where would you target? You would target that area to the left. So this trade would look like this. Again, our stop loss wouldn't be above that wick, it'd probably be at the body. And another great trade, 341. So it's all about the levels. So we can see over here, we've had an opening day gap. So this is where the market's opened, and there's been a huge jump. So these usually get filled, and this is what's happening here. So we come up, we've identified this level here that we're breaking through during what I define as a session in the sketch pad. You can see we struggle to get through it here. Rejection, rejection, and then during session we come up, but we have got no bottom wick. So we would have entered this maybe half size. It would have been a winning trade, and it never gave us the opportunity to go in full size because it never came back and retested. It never even came back and filled. What I would usually do is the 50%. So if you see this wick here and this wick here, everybody knows what a fair value gap is. That's actually what's forming here. You're actually getting a fair value gap form at this area here where this wick and this wick don't meet. So usually when you've got strong momentum, you're going to have fair value gaps. So if I was entering this trade, obviously I've entered half, but if I wanted to enter my other half, it would have been 50% of that fair value gap, like here. Yeah, because this isn't going to come back down. If it comes back down and retests it fully, it's going to fill the gap. Okay, and why do we think the gap isn't going to get filled? Because of a big strong momentum candle going through a level during a session. So let's move on to another if we have one. So we have one here. So again, we've created this level. This example probably isn't ultra clean because the range to the left isn't as good as the others. We have this little consolidation area. So when this comes up, it can react here and, you know, reject. But we entered this trade. This was a trade that was taken, and it was only half size. And I can tell just by looking at this, it was only half size because that's my rules. My rule is if we've got no wick, we don't go in full size. We go in half size. It's still a winning trade, and again, we never get the opportunity here. 50% of between 50% between this wick and this wick. Again, you would have had a fair value gap in there. So your entry for your second to go in full size would have been like this, and you never ever get tapped in. So again, it's very important when I'm doing this that I wait on the 3 minutes, the 3 minute rule. Get out of the trade 3 minutes before the 15-minute candle prints, and that is unless you've got a target, you know, and you know where you're going and you've got a defined target. But a lot of times when I'm doing this, I'll buy lots of contracts and just look for a small move, in and out fast, and I'm in and out most of my trades, not all, but most of my trades I'm in and out on the one candle, and it happens very fast. So there's a right surge comes in, and it feels good. It feels good. You feel as if you're reading the market, you're reading the price action. That's what this is, pure price action. You're not relying on any indicators or anything. You're just watching the candlesticks during a session, and you become a master of this because you're trading the one time frame, 15 minutes. You're trading the one asset, NQ, or it could be gold, and you're trading what you have defined as your session. Again, that could be in Asia, London, or New York. For me, I trade 1 hour to 90 minutes before and after New York and London, and I do not trade the initial open, that initial burst at 9:30. I tend to stay clear of that because the market can wick in either direction. You get big whipsaw wicks, and yeah. So hopefully this video has been useful. Until the next time, stay safe.